And what do I mean by that? Well, Chairman Volcker was dealing with double-digit interest rates. He took interest rates from 10% to 20%. Now, by the time he did that, consumers and businesses had gotten used to maneuvering around inflation. While that sounds shocking, going from 10 to 20%, and it did have some shock value, it wasn't the same as what we're experiencing today with Chairman Powell and the Fed. Today, we've gone from 0.25% on the Fed funds rate to 5, not a twofold increase. Now, many people, I was interviewed by someone the other day and said, oh yeah, but that was such a low base. There's no comparison. In fact, that makes this even more dramatic. That's what's so interesting. People dismiss this way of thinking about it, saying, oh yeah, but the base was so low. The base was so low, and it had been really since 2008 and 9, because we were in a terrible crisis then. And it took a long time to get out of it. And so we did not have inflation expectations built into the system. I really don't believe at all. And yet, Chairman Powell is behaving as though what's going on today with inflation is much worse than what Volcker inherited. Starting from a low base is really shocking the system, especially given how long interest rates have been low. So I question the premise of those who say, oh, this is so different. It's such a low base. That's the whole point. It's a low base. This will be a 16-fold increase compared to Volcker's 2-fold increase. Now, we have been expecting serious ramifications, financial and other ramifications, because of this monetary policy. And we've gotten the first one, but most people here in the United States are not aware of it or haven't thought very carefully about it because it doesn't seem to matter to us. But I was in the UK around the time that it had its near Lehman moment. Near Lehman moment means the financial system implosion. Now, what do we mean by that? Well, there is something called LDI, liability-driven investing, and it's where pension funds match their liabilities with assets. So they will, in its pure form, they will match 1-for-1 the amount that they have to pay out to pensioners as they retire. Now, it would be great if they did match assets with liabilities completely from a safety to the system point of view, but they don't. And with banks and a very low interest rate environment, they got used to using derivatives and taking shortcuts to try and accomplish the same goal. And after a very long period of very low interest rates, I heard someone say the other day, and we were talking about this LDI crisis in the UK, that the reason it's so serious is pension fund sponsors were beginning to think, and banks were beginning to think, that interest rates would stay very low for a very long time, for as far as the eye could see. And that assumption was built into the kind of derivative activity they were doing. No one expected a sharp increase in interest rates. Well, once that happened, pensions began getting margin calls, and they couldn't meet them. And in fact, if interest rates had gone to 8%, and I think they got to 6% over there, if they got to 8%, then according to some of the people close to that situation, whom we have consulted, then the pension system would have collapsed. But it wouldn't really have been the pension system. What really would have collapsed if the pension funds were not meeting those margin calls were the banks, the counterparties in this case for these derivatives. And so the Bank of England had to step in and basically say pretty much the same thing that Draghi said, the chairman of the European Central Bank in 2011. He basically said, we're going to pull out all stops no matter what. So while the BOE had been almost forced because of currency depreciation into following our Fed with higher interest rates, this was going to cause a great deal of harm to its system. And so it had to reverse its policy. So this is another reversal in policy, or it's a bit of a shift in policy. So now all of these pension funds, in collaboration with the banks, are deleveraging. So what do you do if you're deleveraging in an illiquid environment? All markets are experiencing duress today. I think the Fed is a big part of that. So what do? You sell the most liquid assets. What are those? Those are government bonds. And so we're seeing U.S. government bonds, which are held in pension funds abroad, being sold, even though deflationary pressures are mounting all over the place. We think this is a bit of a financial crisis, and we think we'll see it elsewhere as the Fed continues to raise interest rates, as it seems want to do. Certainly this week was full of speeches from all the Fed members reminding everyone that they're going to take interest rates up until we get to 2% inflation.